Hello and welcome to the Trades and Tutorials video. This is Jeff Fish, president of MarketGauge.com, and in this video I'm going to take a look at a simple set of rules to help you figure out when this market may turn up, and perhaps even more important than trying to figure out when it's turning up is how to just avoid getting caught if it doesn't turn up. But before I do that, I want to make sure that if you're just finding us on YouTube, that you please subscribe to our channel, and also please know that you can find more videos like this at marketgauge.com/tutorials, as well as more information on our Twitter feeds at MarketGauge and at Market Minute. Finally, if you're not already seeing this in HD, just change the setting in the lower right-hand corner and the video will be a lot clearer. All right, so here's just a really simple approach to the market that piggybacks the free training we did last week on opening range. I hope you saw it. I just spent a great 2 hours with members this morning going over a lot of opening range tactics live in the market. And one of the things that comes out of trainings like that is an appreciation or a realization that too many traders approach the market as if they have to trade every single day and they have to know which way the market's going to go at all times. Personally, I think most traders are just much better off saying, I'm going to trade when the trend is in my favor. I know that's an old saying, but it's true. So here's a really simple way to pretty much be on the right side of the market. Now, you have to be willing to miss some days, but your objective is just not to get caught going in the wrong direction. So the way that applies to right now in a big way is that the market put in a new pretty substantial swing high right here. We're looking at the SPYs, and then it gapped down. The gap's not as significant as much as that it closed down pretty substantially on Friday. So once that happens, you want to just, all you have to do, once your market has closed below the low of a prior bar, all you have to do is wait for the market to close over a prior bar high and trade above its 30-minute opening range. And when that happens, then you can be never 100% sure, but much more sure that the market has at least enough energy to make a potential turn. Now, as I said in the beginning of this, perhaps the more important and powerful part of this is that for as long as you're trading below the below the high of the prior bar and not trading over your opening range, then you're just waiting for the market to continue to go lower. Now, if you're interested in being more aggressive on the short side, then you can do that as well. My take on the market, however, would be wait for more of the big picture to turn negative to be pushing on the short side. Right now, I just don't want to get caught in a market that could just continue to go down and down. And this one held at the 50-day moving average, but they don't always. And sometimes they just keep going and going and going. And this simple rule will keep you out of trouble. So we don't want to get caught in something like this, thinking each day it's down enough, it's down enough. You want to, once again, let it close above the prior day's high and then trade above the opening range high. And even if you're just focusing, as I described in the free training, even if you're just focusing on the opening range, that will work too. So let's just take a look at what I mean by the 30-minute opening range. And so here again, as I've described in other trainings, you don't want to just look at one index. You want to look at 4: SPYs, Qs, IWMs, and diamonds. So if you have a really basic rule that you're going to look at the first 30 minutes of the day, and all, or let's say 3 out of the 4 really have to be convincingly moving above the opening range high in order to be more determined or decisive or convinced, I should say, that the market has the strength to turn, you'll keep yourself out of a lot of trouble. So the 10th, I know this is scrunched up, but I'll zoom it up. The 10th was that first day when it gapped, when the markets gapped lower. And if we just take a look at how the markets traded on the 10th, you'll see that they were unable to get going back over their opening range as a group. All right, so I'll just focus on the 3 for right now. So you want to see them trade over the first 30 minutes and then move higher. So if we're looking at a 5-minute bar, the SPYs made one 5-minute bar higher and never moved higher. They tried again around 11 o'clock. But when they tried at 11 o'clock, look at what happened to the Qs. The Qs weren't over. And while IWMs were over at around 11 o'clock, really just one bar above and then couldn't get any trend going. So when you see action like that, that's telling you that the market doesn't really have the strength. And keep in mind, you're trading below the low of the prior bars, the prior day. So there's no point in jumping the gun at this point. Right? And now if we just follow how the markets traded, you'll see that for the last couple days, the markets have just eroded. So let's just take a look at the last 2 days, if I can get that on an individual screen here, and see how it would just keep you out of trouble. All right. All right, so I know this is a little scrunched up, but literally this is how broad brush you can look at this. Remember, you're looking for the market to tell you that it's ready to turn. And so yesterday, when the market gapped down in the SPYs, again, we're looking at 5-minute bars against the lows and then rallied up, it was unable to make any real progress over its 30-minute opening range. The same was true in the Qs, okay? And even more so in the IWMs, never even broke out. So no real conviction there by the market to move higher. Furthermore, when it came down to the opening range low, IWMs were never able to get back into the opening range. So IWMs continued to erode. So this is telling you the market is still weak. So now today, once again, market gaps lower, tries to rally, was unable to take out the 30-minute opening range high in any of the markets today. Okay, the 30-minute opening range high has been the high for the day. Furthermore, when it broke the opening range low and rallied back up to the opening range low just recently, it's now faded back off of it. So once you get further below the opening range low, it becomes resistance. And so this is the same kind of pattern. You can see it in each one of the charts here. This is the same kind of pattern you want to look for in reverse. And until you see that, the market's not really ready to turn and go higher. I know it's pretty simplistic, but if you put the opening range, the first 30 minutes of the day, together with the prior day's range and the trend in both of those, you can always keep yourself on the right side of the trend. Hope that helps. I'll see you in the next video, and if you need any more information on the opening range, there'll probably be a link to it in the text of this article.